Okay, so now we are going to talk about chapter 3, which is about budgeting. And frankly speaking, you have quite a few questions relating to budgeting. So you have a question that tests how to update a budget when we have rolling budget. We have a question that talks about advantages and disadvantages of activity-based budgeting and so on. And you will have another question appearing magically on Friday. Okay, so what I wanted to talk to you about is variances. Well, actually, you're supposed to be professional, very fluent in variances because at this very level, it is assumed that you took F5, meaning performance management, and you practiced and practiced and practiced the variances. Well, however, the reality is that some of you got exemption, some of you took that exam years ago, and even if that experience was relatively recent, still I think that variances scare people a lot, and that would be great for us to review the topic. Well, frankly speaking, no one was expecting variances to come in the exam. Why? Well, because ACCA does not test you on something that was in previous papers, because there were previous papers that tested you on the subject. However, occasionally we have surprises. And that is what happened in June 2023. There was some students got question relating to variances, different kinds of variances. So how about we revise that and also talk about the relation between variances and types of budget. Okay, so we have a company that plans to produce 1,000 units, and that is its budget, but actually it produced and sold 1,500 units. And in these questions, we assume that whatever was produced was sold, so that we do not have anything in inventory. However, the price at which the sale happened got lower compared to the budget. As for materials usage, the planned spend was higher than the actual. However, the cost per kilo, the actual cost per kilo was higher. And the same idea is given here for labor. But with the labor, we have a thing that is not met with materials. It is idle time. Meaning that for materials, you pay, if you get 10 kilos of materials, 10 kilos is what you pay for. But with labor, we cannot ask a person to come and work for us for, let's say, 17.5 hours. We need to hire them for a shift, for example. And if a shift lasts for 8 hours, then they will need to be employed for 24 hours, meaning that that difference of 6.5 hours is going to be idle time. Idle time means that employees got their salary or got their wages, but did not work for the company. And that is what we have, the difference that we have. We also have variable overheads. Variable overheads depend on something, and usually they are based on either quantity of units or labor hours or whatever. And we have fixed overheads. And we have total fixed overheads, and depending on the way that we produce our accounting, managerial accounting, these overheads are apportioned or are not apportioned to the product based on the cost driver, such as labor hours in our example. So in this very question, we will need to calculate variances, but we also want to talk about variances. Yes, and if you have a question, you are more than welcome to ask the question, either in typing or by voice. So no problem with that. Yes.
Submitted my answer in mail, so we are not going to discuss that in the class, or
Okay, your voice is like too
Cracking?
quiet.
Is it cracking? Is it better now?
Can you say that again, or could you please type it, because the voice is very sound is very quiet.
Is it better?
A little bit, I think.
Maybe just let me plug in my headphones. So a minute.
Okay, like there is an echo. Could you please type that in the chat box, okay? And then I will read that aloud and answer the question. Okay, and in the meantime, I will tell you where we are going. So, when we originally planned our stuff, our performance, we had some budgeted figures. So we had some budgeted P&L, and let us calculate that. We budgeted sales in the amount of output multiplied by price. Let me just calculate that output and the price. Yeah, we are going to discuss answers for quizzes for quiz 2. But we will do that a little bit later to the evening. We will start with variances while you are fresh, because variances and numbers, and you can have to pay attention to them. So variances for now. Okay, so we planned to produce that many units, and I'm going to move the camera so that does not block my screen. Now, as for materials, the usage of materials, we know that we need to spend 6 kilo per unit, and we have 1,000 units, and the price per kilo is 12. The same idea is for labor. We know that we need 2 hours of labor per unit, and we plan to produce 1,000 units, and the price is 12. Variable overheads. So we know that variable overheads per hour are 3, and they are given to us per hour. So we need to multiply them by hours worked and multiply by the output. Well, as we do not have any machine hours, so it is kind of obvious that per hour means per labor hour. And as for fixed overheads, as they are fixed, they were originally planned in the amount of 3,000. Okay, so let us see what is the result that we were planning. It's 95,000. Perfect. Now, look, some time passed and we now have actual results. And when we calculate actual numbers, let me just do that like that. I will copy that column, paste it here, move it, and the only thing that I will need to correct is labor spent. So I will need to get hours that were actually paid, multiply that by hourly rate, and I will get 43,450. The same is calculated using the same logic. So we take output multiplied by price. As for kilos, we take the actual kilos per unit multiplied by actual units multiplied by actual cost per kilo, and so on. And that is the actual profit that we've got. Okay, now we want to appraise our managers. And if we just take the difference like that, actual minus budget, it's going to be very demotivating. Why? Well, because since we sold by 50% as many units as we planned, we thought 1,500, whereas we planned to sell just 10. If we come to, let's say, production manager and tell them that they're to blame because cost of sales in terms of materials is by 25,000 higher, they say, well, yes, it is supposed to be higher. That is because we produced more. So what we need to do, we need to produce flex budget. So our appraisal is never done with the reference to the original budget. No. never original. Instead, we need to make that with a reference to flexed budget. Flexed budget means that we take into account the actual production. So let me see how it works. We take the materials that are here. So we take the actual consumption of actual materials per unit, multiply that by actual units sold, and multiply that materials. Okay, flex budget. Sorry, we take the materials usage, multiply that by budgeted. We take budgeted materials usage, multiply that, by actual quantity, and multiply that by cost per kilo. And now let me make that better formatting, and let me discuss that. So look, we want to calculate flexed budget. Flexed budget means what would be the expense if we had the same consumption as budgeted, but if the sale was as actual. So as such, we take budgeted consumption, budgeted cost, but multiply that not by 1,000, but by 1,500. The same goes in here for labor. We take 2 multiplied by 1,500 multiplied by 12. The same goes for variable overheads. We take $3 per labor hour, multiply by the budgeted hours, budgeted consumption, and multiply that by actual units. And finally, if we talk about fixed overheads, well, that is going to actually depend whether we are using absorption costing or marginal costing, because when we talk about absorption costing, we treat overheads as if they were variable. So what we need to do, we need to find overhead absorption rate. Overhead absorption rate is calculated based on budgeted information. We say, okay, so we were planning to spend 3,000 on overhead, and we were planning to get an output of 1,000. So we were planning to get $3 of fixed overheads by per a unit of production. So in here, when we are going to calculate fixed overheads, let me connect my laptop to the electricity before it's late. Yep, I'm back. So I take this overhead absorption rate and multiply that by actual units produced. That gives me profit of, well, now it's not profit, yes, it's just expenses. And the question is, what do we put as revenue figure? Well, actually, when we talk about flexed budget relates to overheads rather than to expenses rather than to revenues. But in our example, let us take revenue the same as was budgeted. Okay, so flexed budget is 42,500. And now let me show you how to calculate variances. And after that, we will see why we put this sales figure as a 200,000 and not as 225,000. So for sales variances, we have two kinds of variance, price and volume. Why? Well, because then they are under the responsibility of different managers. So we need to distinguish between that. So price variance. When we talk about variances, sometimes it is hard to remember what we take as standard and what we take as actual. And the idea is the following. If you are calculating some cost or price variance, such as price variance, rate variance, you need to take actual quantity. If you're calculating some sort of volume variance, you need to take standard price. Well, let us do that. So for sales variance, for price variance, we take the difference between prices, so actual minus budgeting, and we I will tell you about that in a second. Not price variance, however. Yeah, so we do not do like that. With sales and price variance, there is a little bit of a difference. It stands out, and we will talk about that later. Okay, so I multiplied by column C3. Okay, so for sales variance, I will put an asterisk here, and we will talk about prices a little bit later. But still, how we calculate that, we take the difference between actual and budgeted and multiply that by actual. Sales volume variance, we take the difference between volumes, actual and budgeted, and multiply that by the standard price, not actual. And now what if I'm going to put arrows here, you will see that arrows actually cover all the parts of our original data. So we take everything that is that. But anyways, for price variance, we took actual quantity. For volume variance, we took budgeted price.
Yeah, I have a small question.
Yes.
Am I audible now?
What is that?
Am I audible now?
Okay, you have can you repeat the last sentence?
Am I audible now? Can you hear me?
Yes, I can hear.
Perfect.
Yes.
Yeah. So I just want to know why we are using actual in price and budgeted in actual in output in price variance and budgeted in volume variance. What is the reasoning behind it?
Okay. Well, great that you've asked that. So why? Well, because actually I feel a little bit shy talking to you about this topic, because it is kind of like assumed knowledge. Yes, and now I feel that it's not in vain that we are spending this hour here to talk about that. What is the reason for variances? We want to understand who is to blame and who is to praise. That's why we want to break down the difference between actual figures and flexed budget in parts. It's less understandable for sales, but let me show you how it works with materials, and then in the end we will go to sales variance, because it's actually a little bit tricky and we will need to discuss it a little bit further. But still, as for price variance, so for material price variance, as it is price-based variance, we need to take the difference between the prices. So actual cost per kilo minus budgeted cost per kilo, and then we need to multiply that by budgeted consumption. And that is going to be tricky because we need to multiply that by actual output. Price variance, sorry, by actual consumption and by actual output. So look, when we are going to calculate variances, we will always take actual output, but for our volume variances, we will take budgeted consumption. So it's going to be a little bit tricky. Well, let me illustrate that in a second. And after we've calculated the variance, we need to think logically whether this variance is favorable or adverse, meaning that whether it works for the benefit of the company or for the worse of the company. And in here, we look at whatever is in brackets, and in brackets, we have these prices of material, this cost per kilo, and we see that budgeted was 12 and the actual was 13, so we paid more. As we paid more, it is bad, it is adverse, so it has to go with a minus sign. So we first write the variance and then think logically what is going to be the sign. As for usage variance, usage variance is when we take the difference between usages, we multiply that by actual quantity, and we multiply that by budgeted cost per kilo. Okay. And now we need to think about whether it's for the benefit or for the worse. Well, we were planning to spend 6 kilos per unit, but spent 5. So the amount that is in brackets is for the benefit of the company. So it has to go with a plus sign. And in here we got minus. So we need to put minus in front of it. Now, why have we calculated the variances? Let me calculate the total of the variances and show you what we've got. Okay, look, in here, we have actual figures and budgeted figures. When we say budgeted figures, we always assume that it's flex budget and not the original budget, meaning the budget that was updated by the actual quantity sold. And we find out that the materials variance is actually lower than was expected. So we were supposed to spend $108,000, but spent $97,500. So we won. But now the question is, who is going to receive a bonus? So is it a production manager who was so good in using the materials? So for example, they put their parts on the metal sheet better so that there is less waste, or for example, they improved some processes so that less materials is used, or whether that is the win of the procurement manager, so that the manager who talked to suppliers asking them to provide a discount. And from here, from this analysis, from the breakdown of materials variance, we see that price variance is actually adverse. It's minus 3,500. So actually, the procurement manager did poor job. They were not able to get a discount that is as big as was planned, as was budgeted. But the production manager did great because the production manager was able to decrease the usage. And that means that production manager needs to get a bonus. So this variance analysis allows us to break down the total variances, so the difference between actual and flex budgeted figures in our P&L, to areas of responsibility. If we are asked to produce an analysis, of course, we need to say however. We always need to say however. However, the problem is that maybe the materials cost more than expected because materials of better quality were bought. And that means that it is expected that the price variance is going to be negative because better quality calls for higher prices. And because materials of better quality were bought, less scrap was, less waste was needed. So they did not, well, for example, if you make a cake and you buy, let's say, bad eggs, and you break them and you see that that one is bad, that one is expired, and you need to, let's say, get 10 eggs, buy 10 eggs to get just 8 egg worth of your dough. But if you buy these eggs of better quality, then you know that each and every egg that you are going to use is going to be of perfect quality and you can use all of them. You will not have any waste. Well, the same could have gone in here. Now let us have a look at labor variances. Labor rate variances is calculated as the difference between rates. Yep. So we have actual cost per hour and budgeted cost per hour. But also for labor rate variances, we need to look at what is the hours that we are going to take, because look, there is a difference a little bit, because hours that were actually paid are 39.50 and hours that were actually worked are 2.5 multiplied by 1,500, so it's 37.50. So the question is, what do we need to multiply rate by? And the answer is, when you find your cost per hour difference, you need to multiply that by actual hours paid, because for labor rate variances, for price type of variances, you always take the actual amount, not some intermediary amount, only the actual amount. And again, let us think about whether it's for the benefit or for the worse. It's actually for the benefit, so it has to be positive. So we need to put a minus sign in front of it. Now, efficiency. Efficiency variance is about how well the employees worked. So they spent 2.5 hours per unit, whereas they were supposed to spend 2 hours per unit. And they worked for 1,500 units. And we need to take the standard rate, standard labor rate. So we will multiply that by 12, and that will give us 9,000. And again, is it good for us or is it bad for us? Well, that is actually bad for us. Yes, it's bad for us because we plan to spend 2 hours, but spend more. So we will need to put a minus inside in front of it and get minus 9,000. Idle time variance. Idle time variance is the difference between the hours that were actually paid, so that is 39.50, and hours that were actually worked, so that is actual hours per unit multiplied by actual units. And as this is volume type of variance, it needs to be multiplied by cost per hour, and we get 2,400. And again, as we have idle time, the variance is going to be adverse. Well, actually, idle time variance is always adverse because as we're supposed to pay people not less than their time that they've spent, so idle time variance is going to be always negative, because idle time, people not working, is bad for us. Now let us have a look who is to blame or who is to be rewarded in this very case. When we talk about idle time variance, that is the fault of the person who was making allocation work. So who was allocating work? So for example, project manager thought that they would need, let's say, 10 people, whereas in fact they needed 9 people or 9.5 people. As for rate variances, this is HR who is to praise or to blame. Well, in our case, to praise, because they were able to find cheaper labor who would be paid $11 per hour and not 12, and as such they saved money. As for efficiency, well, we can say that these are actually workers because the workers worked worse, or maybe this is about some processes, and maybe that is about production manager who just made poor processes, and as such people had to work more to get the same unit. So that is why we analyze labor variances. And if we calculate the total of them, we will get minus 74.50, which is the same as the difference between the actual line and flexed budget line. So that is why we need this labor variances broken down by rate, efficiency, and idle time to know who to blame for the difference between actual and flexed budget for labor line. Is that clear? Okay, well, I do not hear any comments so far, right? So, okay. I have a question in chat. Okay, it's clear. Thank you. Now, as for variable overhead variances, let us have a look. Rate variance, again, that is we have variable overhead per labor hour, so we will find the difference between them. We will multiply that by actual hours worked, We will multiply that by actual units produced. And that is going to give us 1875, and that has to be with a minus sign because we paid more than we were supposed to. And as for efficiency, well, we will need to find out how much labor worked compared to what we thought they're going to work. And the question would be whether we take 3950 or we take 3750. Well, efficiency means how well they worked, not how well the person who was allocated work, who was thinking about how many employees to hire, was planning the work. So as such, we do not take 3950. Instead, we take 2.5 minus 2. We multiply that by actual output, and we multiply that by standard rate. We will multiply that by standard rate because we need to find volume-based variance, and again, it's going to be with a minus sign. Ooh, perfect. Now, when we talk about overheads, let us calculate overheads. So when we talk about fixed overheads, it will depend on what is the costing method that we're applying. So whether we are using marginal costing system or whether we are using absorption costing system. Well, we will look at absorption costing system. So we will find what is the overhead absorption rate. We've already done that. And now let us calculate the expenditure variance. So to calculate expenditure variance, what we will need to do, we will need to find the difference between the actual overhead paid and the budgeted overhead paid. And that is going to be taken based on the original budget. So that is the only exception in this rule that we take flex budget. For fixed overhead, when we calculate expenditure variance, we find the difference between actual and original budget. Why? Because fixed overheads by default, well, they do not need to be changed when we have the change in volumes because they're fixed. Now we need to take efficiency variance. And we think that our fixed overheads are apportioned based on labor hours. Yes, based on labor hour. So what we are going to do, we are going to find the difference between the labor hours that were worked, the labor hours that were budgeted, so efficiency. Labor hours worked is 2.5 multiplied by 1500 minus whatever was budgeted, 2 multiplied by 1000. Now we will need to multiply that. That is the difference in hours. Yes, so that is 1750. Now we will need to multiply that by overhead absorption rate that we've got, and that is going to be 3. And then we will write that is 3. Okay. Good, right? Yes, so what have we got? We've got 52 and 50. Something is wrong. Let me just double check that. What's so we took overhead absorption rate here. I refer to 3. Let me just refer to this 3. Okay. And overhead absorption rate is here per unit. Oh, and we need to make that per labor hour, of course. Okay. And what is wrong with my labor hour? I found the difference in units. Okay. Okay. Oh, okay. Hold on a second. I will change first. Yes. Make sure that I will correlate. Okay. Once again, let me write the formula again. When we talk about efficiency, efficiency is volume-based variance. When we have volume-based variance, we need to take that budgeted price, and as our fixed overheads are portion based on labor hour, then we need this overhead absorption rate calculated based on units, divided by labor hours per unit. So we will divide that by this 2. Up. Okay, and now we will need to find out the difference between labor hours. So minus 2.5 minus 2. We will need to multiply that by actual units. And now we need to think about whether it's good or bad. Well, efficiency got worse because we spent 2.5 instead of 2. So it minus 11.25. Now let's go next and let's talk about capacity. Well, capacity is going to be calculated as follows. We need to understand how much we used compared to how much we could have used. So as such, we will need to multiply our labor hours per unit, which are actual, by the actual volume. So that is the hours that we actually worked. However, how many hours we thought we could squeeze out of our plant? 2 multiplied by 1,000. And that needs to be multiplied by overhead absorption rate per labor hour. That is 26.25. That is what I mistakenly calculated originally. And let us see whether this has to be positive or adverse. Well, look, as for capacity, now we were able to work actually 2.5 multiplied by 1,500. But we planned to work 2,000 hours. So we were able to squeeze more capacity out of the plan than we budgeted. So the the variance is going to be favorable. So it's going to be with the plan's sign. And now I'm going to calculate the total for fixed overhead variances. And that is going to be minus 22.50. And look, that is the same that we've got in here. Okay. Now, what we can do, we can reconcile a profit that we've made. So look, what we've got here is we've got a flexed budget. So we had a flexed budget profit. Yep, 42,500. Then we need to take the variances that we've got. And after that, we will need to let me add the variances. And I have not calculated the total sales variance. Oh, and the total variable overhead variance. Well, anyways, I will just make this totals here right now, and we will see what is going to be the total result. So look. That is sum of variances. And that is actual profit. So it might as well be that the question is that the budgeted profit was like that. These are the variances. What is the actual profit? Well, the actual profit is calculated like that. I highly doubt that there will be some question because it is more about this fundamental part of ACCA exam. So it's more about F5. Well, but still anything can happen. Now, let us calculate what we can calculate. Oh, we can calculate, talk about sales variances. right? So in here, we have sales variance of 25,000. And that's a sales variance is the same as in here. Yep. But what else could we have calculated? We could have calculated volume variance a little bit differently, because actually when we talk about sales volume impacts not only on revenue and as such on this very variance, but it will also impact on how much materials we use, on how much labor we use, on how much variable overhead we use, and if we use absorption costing, on how much fixed overhead we use. So what we need to calculate, we need to calculate net profit per unit. And net profit per unit is going to be calculated as sales price minus kilos per unit multiplied by cost per unit, minus labor per unit multiplied by cost per hour, and minus variable overhead per labor hour multiplied by number of labor hours, and minus overhead absorption rate per unit. Okay, so that is 95 in here. Oh, and 49, that's little in here. Oh, the wrong way. Okay, now when we calculate our variance, our volume variance, what we will need to do, we will need to subtract the volumes. So 1500 minus 1000, and we will multiply that by net profit per unit, and instead we will get the variance of 47,500. And what is going to be the difference? Well, let me put here the same price variance, calculate the total that I've got here, and this 27,500 is actually the difference that we are going to get if we why would we need this 27,500? Well, let me show you. If we take profit that is per original budget, profit per original budget, that is going to be 95,000. And now we will calculate some of our variances, taking into account volume effect of sales. And this means that I will need to sum 27,500, and the rest of the variances are going to stay the same. And now let me find the total of these two figures. Oh, look, that is what we needed to arrive at our actual profit from the original budget. Now, again, when we talk about sales variance, we, on some rare occasions, may calculate volume variance based on price, but that is not the best way to do that. Well, it has some logics. It has some logics because it allows us to arrive from flexed budget to actual. It allows us to see how much revenue is compared to the original budget, but in more relevant way, it would be to calculate volume variance based on net profit if we are talking about absorption costing. Okay, so that is how we calculate absorption costing variances.